Hi guys, welcome back. Today we will be having application of relevant costing to accepting or rejecting a special order. Special order. A special order is a sales order with terms different from those of regular sales. Such terms might include a reduced price or added features in the products. Take note that since it is not a regular sale, it is not expected to happen again. More likely, this would be a one-time event only. Remember that in short-term decision making, the goal is to increase the profits in the current year. That is what we'll look into. What's the impact of this decision to the current year profits? In order to analyze the situation, let us put the numbers into the following template. What would happen if, alternative 1, we reject the order, or 2, accept the order? If we reject the order, needless to say, nothing will happen. Zero change in our profit. But if we accept the order, sales revenue would go up. However, costs should also go up in order to cater the special order. However, there is a possibility that in accepting the special order, capacity dedicated to regular sales will be sacrificed. This can lead to an opportunity cost. Overall, there could be an increase or decrease in profit. If the incremental effect is a profit, then financially speaking, it would be best to accept the order. But if the incremental effect is a loss, then financially speaking, it would be better if we're going to reject the order. What about the incremental cost? What is this incremental cost? If the case is silent, the presumption is that all variable costs, both manufacturing and selling and administrative, would be considered incremental. All variable costs, if silent, would be considered incremental. Why is fixed cost not incremental? Well, this is only an allocation of fixed cost per unit. It doesn't mean that when we're going to produce or sell additional units, the fixed costs will increase by that amount. By definition, fixed costs shall not change. To understand further about special orders, let us refer to the following case. F&D Company is a manufacturer of a computer component called BX. It can produce a maximum of 10,000 BXs in a year, with each BX regularly selling at 50 pesos. F&D Company is contemplating on accepting a proposal from a customer asking for a price reduction for a bulk order. MF Enterprise would like to purchase 2,000 BXs at a price of only 30 pesos. The following data pertain to the cost structure of one unit of BX. For our first scenario, if FND expects to sell with regular terms 8,000 BXs in the year, is it advisable to accept the order of MF Enterprises? Before answering that question, let's look at the capacity of FND. FND can manufacture 10,000 units in 1 year, but only 8,000 units are needed for regular customers. Hence, there would be an excess capacity of 2,000 units, which means if we accept the special order, we do not need to sacrifice any regular sales. No opportunity cost. Let us refer to the following analysis. If the order will be rejected, nothing will happen. If the order will be accepted, revenues will go up by 30 pesos per unit times 2,000 units, 60,000 pesos. Costs would also increase by 10 peso per unit only the variable cost times 2,000 units. That's 20,000 units. Note that there would be no sacrifice of regular sales, hence zero opportunity cost. Profits will go up by 40,000 pesos. An incremental profit indicates that the company would be better off if we accept the order, at least financially speaking. Second scenario, if F&D expects to sell with regular terms 10,000 DXS in the year, is it advisable to accept the order of MF Enterprise? This time, we are going to notice that the regular sales will utilize the total capacity of 10,000 units. As a result, accepting the special order would mean that we need to sacrifice 2,000 units of regular sales. Hence, there's an opportunity cost. Let us analyze. If the sales would be accepted, revenues would go up by the same. 30 pesos times 2,000 units, 60,000 pesos. Cost would also increase by the same. 10 pesos times 2,000 units, that's 20,000 pesos. But this time, there is an opportunity cost. What is the opportunity cost in accepting this order? Remember that the capacity now being utilized to make the 2,000 units of special order could have been utilized for the production and sales of regular sales. Hence, we lost 2,000 units of regular sales. So how much is the opportunity cost? The opportunity cost would be the contribution margin of the regular sales loss. Hence, it would be regular price of 50 minus regular variable cost of 10 times 2,000 units sacrifice. 40 times 2,000, that's 80,000. 80,000 pesos of margins were lost because we have given the capacity dedicated for regular sales to special orders. We would have a net increase in profits will have a net decrease of 40,000 pesos. Financially speaking, it would be better for F&D if the order will be rejected. Next, let us analyze cases wherein we would need to know how much price are we willing to tolerate before we're going to experience a loss. We call this the minimum price. Third scenario, if F&D expects to sell with regular terms 10,000 BXS in the year, of the variable cost of 10 pesos, 2 pesos pertain to routine sales commission that can be avoided in the order of MF Enterprise. What is the lowest price acceptable to F&D? To arrive at the minimum price, let us use the following formula. Minimum price is equal to incremental cost plus opportunity cost. In this scenario, not all variable costs will be incremental. Accordingly, it would only be 8 pesos, the original 10 pesos, less the 2 pesos routine sales commission that can be avoided. Meaning, not all variable costs would be incremental in this case. Incremental cost of 8 pesos plus the opportunity cost of regular price 50 less regular variable cost 10. 50 minus 10 is 40. We would have a minimum price of 8 plus 40, that's 48. What does this mean? It means that a price lower than 48 would mean that there would be an incremental loss in accepting the order. And hence, we should not tolerate any price lower than 48. Let us analyze. To prove that this is true, if we accept the order, sales revenue will go up by 48 times 2,000 units, 96,000 pesos. Incremental cost only 8 times 2,000 units, that's 16,000 pesos. Opportunity cost is the contribution margin of the foregone regular sales. 50 minus 10 times 2,000 units, 80,000 pesos. The net effect on profit is 0. Again, it means that a price lower than 48 would mean that we are going to experience losses. F&D will experience an incremental loss. Scenario 4. Assume that of F&D's variable cost of 10 pesos, 2 pesos pertain to routine sales commission that can be avoided in the order of MF Enterprise. How many regular sales units will F&D be willing to sacrifice if the special order is priced at 34 pesos? In this scenario, we would want to know how much regular sales are we willing to sacrifice in order to cater a special order. We can arrive at this using the following formula. Maximum sacrifice is equal to the total contribution margin of the special order divided by the unit contribution margin of regular sales. We would have special price 34 minus the special order's variable cost 8 times 2,000 units, the number of units in the special order, divided by 50 minus 10, the UCM of the regular sales. We would have 52,000 pesos divided by 40 pesos. The maximum sacrifice of regular sales would be 1,300 units. Again, it means that we are willing to sacrifice only up to 1,300 units of regular sales to accept the order. To prove that this is true, let us look at the following analysis. If the special order would need a sacrifice of 1,300 units of regular sales, accepting the order will increase revenue by 34 times 2,000 units, 68,000 pesos. Incremental cost would be only 8, that's 10 minus 2, times 2,000 units, 16,000 pesos. Opportunity cost would be 50 minus 10, the regular sales contribution margin, times 1,300 units, as we have calculated. This would give you 52,000 pesos. At the end of the day, profit change will be 0. Meaning, if we sacrifice more than 1,300 units of regular sales, F&D will suffer an incremental loss. So this is how we are going to analyze when it comes to short-term decisions. We look at the impact on the current year's profits. In the case of special orders, considering this will not happen again, this is a one-time order, we would only look at its direct impact. Will it increase sales? Yes. Will it increase cost? Definitely. And watch out for opportunity costs. In the next video, we are going to apply the concepts of relevant costing in a make or buy decision. Like, share, and subscribe.